How the rich avoid paying taxes. You have likely heard that the wealthy continue to amass more wealth, and one of the ways that they accomplish this is through a tactic known as tax avoidance. The Federal Reserve reports that the wealthiest 1% of families in the United States possessed 23.3% of the country's wealth in the third quarter of 2023, which is an increase from 22.8% in the same period of the previous year. However, according to the most recent data from the Internal Revenue Service (IRS), the average tax rate for the top 1% of individual taxpayers based on adjusted gross income was almost exactly 26%. Tax avoidance is a tactic that can be implemented to decrease your tax bill regardless of your income, and it is completely legal, in contrast to tax evasion, which means that you could be sentenced to prison for your actions. All that is required of you is knowledge of how to take advantage of some of the most common tax loopholes that affluent people employ to minimize their annual tax payments. Here are 12 different methods by which you can reduce the amount of money you pay in taxes. Number 1. Claim depreciation. The wealthy can reduce their tax burden through the use of depreciation. In that case, what exactly is it? Depreciation is a deduction that allows you to recover the cost or other basis of certain property, according to a piece that was written by tax expert Kelly Phillips Erb for Forbes. Depreciation is a deduction that allows you to recover the cost of certain property. In general, you start to depreciate your property when you put it into operation for the first time. However, this has the potential to be a challenging situation. Not when you start using the property, but rather when it is ready and available for use, is when the Internal Revenue Service deems it to be placed in service. Unless there is an exception, you are required to depreciate the cost of the item throughout its useful life, which is determined by the type of property. Number 2, take care of your business expenses. There are significant tax advantages that could be yours if you run a business. Business owners who are submitting their taxes can claim prospective tax deductions for a variety of business expenses, including those associated with travel, vehicles, office supplies, and education fees related to their place of employment. However, not every endeavor is eligible to be considered a business that is eligible for such tax write-offs. To be eligible, you must have the intention of earning a profit from your business, as opposed to engaging in activities that the Internal Revenue Service views as nothing more than a hobby. On the other hand, there are situations when the distinction between business and hobby is not clear. If you want to avoid missing out on a genuine deduction or claiming a deduction that you are not entitled to, you must be aware of the distinction between the two. Number 3, hire your kids. Business owners can put more money back into their wallets if they make their enterprise a family affair with their family. For instance, there is the possibility of obtaining tax benefits by employing your children to perform genuine work in your company. According to the Internal Revenue Service (IRS), payments for the services of a child under the age of 18 are not subject to Social Security and Medicare taxes. The parents of a child's businesses, including partnerships and sole proprietorships, were the subject of this statement. In addition, the income of your children will not be subject to taxation unless it is greater than the standard deduction. For the tax year 2023, the standard deduction is going to be $13,850, and for the tax year 2024, it will be $14,600. The following are some additional tax benefits that come with employing your children in your company. As an expense for your company, you can deduct their pay. Number 4, carry forward any losses incurred by the company. Even affluent people experience financial setbacks in business, but they can turn those losses into opportunities for growth. According to a law established by the Internal Revenue Service (IRS) known as net operating loss carry forward, owners of businesses that experience a loss in a given year are permitted to carry the loss forward to a subsequent year in which the deduction would be more advantageous. In his writing, Erb stated that business losses are sometimes referred to as net operating losses (NOL). A net operating loss (NOL) is typically the outcome of your tax deductions being greater than your taxable revenue. If a number is negative in one year but has been positive in prior years, resulting in tax payments, then that does not appear to be a fair situation. The NOL was created so that you could bring about a balance to that imbalance. You can, in other words, use the loss from one year to reduce your taxable income and your tax burden in the following year by using the loss from the previous year. Number 5. Instead of relying on your job to bring in money, invest it. According to Eric J. Nizzle, an accountant headquartered in Pompano Beach, Florida, wealthy individuals can make their money work for them, rather than having to work for it. Investing vehicles that provide distributions, such as master limited partnerships (MLPs) and real estate investment trusts (REITs), are structured in a manner that has the potential to create a consistent income stream. Other possibilities include investing in stocks or real estate by purchasing rental properties. Both of these are examples of investments. It is important to keep in mind that you will need to make substantial initial investments before you begin to earn returns, and returns are never guaranteed. Number 6. Sell any real estate that you have inherited. By taking advantage of the step-up in basis, you can reduce the amount of capital gains taxes that you are required to pay on a piece of property that you have inherited. If you purchase a piece of land for $200,000 and subsequently sell it for $450,000, you will be required to pay taxes on the $250,000 gain that you made from the sale of the land. Nevertheless, if your parents buy the land for $200,000 and you inherit it, your new basis will be the property's fair market value at the time you inherit it. This is because your parents will have purchased the land. If you sell it immediately, you will not be required to pay any taxes on the gain of $250,000. Number 7. Purchase a whole life insurance policy. When you think of life insurance policies, you typically think of the necessity of providing for your dependents if you pass away. The purchase of entire life insurance is a cover approach that is utilized by wealthy individuals. A mix of an investing account and an insurance policy is what this is at its core. Number 8. Put your income on hold. The amount of income that you get in any given year is the only amount that you are required to pay taxes on. Even though you have finished the task and are entitled to payment, if you do not receive the payment until the following year, you will not be required to pay taxes on it until then anyway. Therefore, if you can postpone the receipt of money by even a single day, from the 31st of December until the 1st of January of the following year, you will be able to delay the payment of tax on that income for an additional year. Number 9. Start an HSA account. An account that is tax-deferred and was initially created to pay for medical bills is known as a health savings account. But if it is used correctly, the account has the potential to become tax-free 3 times over. To begin, payments to a health savings account HSA are tax-deductible, even if you do not provide an itemized list of deductions. The future earnings in the account are not subject to taxation. Last but not least, distributions are exempt from taxation if they are used to pay for healthcare expenses that meet the criteria for doing so, which are the same as the standards for deductible medical and dental expenses on Schedule A. In most cases, a penalty of 20% is imposed on distributions for expenses that are not related to healthcare. One other enticing factor that wealthy individuals who are also knowledgeable about taxes might utilize to their advantage is as follows. You are free to withdraw money from your health savings account HSA for whatever reason you choose when you reach the age of 65. However, you will still be required to pay regular income tax if you use the money for expenses that are not related to your health. If you become disabled, the same applies. Number 10. Create a 401k plan for yourself. The majority of workers employed by larger firms are familiar with the 401k plan, which enables employees to make tax-deductible contributions and delay the taxation of the growth of investment gains. Those who make contributions may be aware of the annual contribution ceiling, which is already $22,500 for the tax year 2023 and will increase to $23,000 for the tax year 2024. When it comes to making contributions to a 401k, you might believe that you are out of luck if you hold a job that requires you to work for yourself. To tell you the truth, if you are self-employed, you ought to think of it as a stroke of good fortune. Individuals can establish their own solo 401k plans, and they are also able to make contributions of up to a staggering $66,000 for the year 2023 and $69,000 for the year 2024. If you are at least 50 years old, you are eligible to receive an additional $7,500 in catch-up contributions for either of the 2 various types of plans. Thank you for watching, and please like, share, and subscribe. See you later.